Can we come back to you though in terms of your blended portfolio approach? Because it's that you can have commodities which are in a bull cycle and others which are in a bear markets, right? So I'm thinking uranium, for instance, has not been flavor of the month for the last few years, but you were pro it. But then you realised gold was going to go shooting past it on the outside lane. So you switched cars. Well, you didn't switch cars. There was another horse in the race for you there. So you've got options there because you can sit back. Because one of my favourite phrases that you use is it's the "I will be correct eventually," or words to that effect, which is when you've placed a bet and you can sit back and wait. Which some people have the luxury of doing, and I think retail perhaps get a little bit more frustrated than you do. You're saying I've got foresight, but you're all in on gold at the moment, which is great, fantastic. But do you feel that therefore you've got the luxury of a different type of approach? You've got a different business model to retail and family offices, haven't you? In effect,
maybe. Because it's mine, I think it's correct. I'm not going to change. I think they should, but that's. I think, first of all, I think that the wind is in gold sails. I think that the policy response from the political class worldwide is awfully likely, maybe not certainly, but probably going to continue to propel precious metals higher. And the consequence of that is that when the higher gold price becomes reflected in the balance sheets and the income statements of the producers, that they will follow, like they have in the last 8 recoveries from oversold bottoms. That doesn't keep me out of the uranium space. The exact quote, to demean myself, was, I usually forget that there's a difference between inevitable, which I almost always get right, and imminent, which I always get wrong. What I've learned at age 67, however, is that 3 to 5 years is not an interminable length of time. In my career now, I've been through 9 5-year cycles. And oddly, while I have less time on Earth and time should be more precious, I become much more patient. So I see, for a variety of reasons, the pressure off the uranium price to go higher. I had believed 2 years ago that it was sort of 18 months before the Japanese reactor fleet restarted. And in that case, I wasn't early, I was wrong. But I love the arithmetic associated with the uranium. I love the amount of energy that can be generated from a fairly small amount of fuel. I love the fact that if you have $7 or $8 billion into a reactor, and that reactor is using, say, 1 million pounds of fuel, the price of uranium is actually irrelevant to you, relevant to the cost of the capital employed, regulatory affairs, and things like that. So if the price is $30 a pound, you use it. If it's $60 a pound, you use it. If it's $120 a pound, you use it. The price of the input, the price of the uranium, is irrelevant to the price of the output, the electricity. And if you have a circumstance like today where the stuff is priced at 60, but the fully loaded cost to produce it, including cost of capital, which the industry never talks about, is 50, that means that the industry worldwide is losing sort of $20 a pound and doing.
I think you said 60. You meant 30, yeah? The price is 30.
We're selling it for 30.
Yeah. Okay.
But fully loaded, including cost of capital, and importantly, including prior year write-downs, which companies never like to talk about, the total cost associated with producing a pound of uranium worldwide, we believe exceeds $50 a pound. So if you're making this stuff for 50 total cost and selling it for 30, losing $20 a pound, and of course being a miner trying to make it up on volume, over time, that's simply unsustainable. And I would suggest to you that the price of something that has to go up and can go up will go up. I just can't tell you when.
I won't even ask, because I think I've long lost faith in the ability to call that market. I should say that the math is fantastic. The reality is somewhat more opaque in that inventory and mobile inventory it seems to be an unknown. For such a small market, right. That's quite extraordinary. Well, let's kind of move on from, well, actually, just talk about uranium just a little bit more, because obviously there's a lot of, COVID has impacted supply. You've been talking about the demand side. there partially, but the supply side has been knocked for six, to use a cricketing analogy, whereby 25 to 40 million pounds taken out of the market, depending on how long this goes on in for, because it's rather indeterminate at the moment. So there's hopefully a big better be careful of my wording here. There's a wave of price discovery to happen, which is great. Are you at all concerned about the lost opportunity cost, having had your money tied up there for the last 3-4 years? You could have come back in now, made your cannabis money, made your Bitcoin money.
I resent it, but it's a cost of doing business for me. Yeah, it's a cost of doing business. The last uranium bull market, which I was early on too, I began to come into that market in 1998. And I guess the market started to move in 2002. I had the same circumstance. I had foregone rent in the money that I had employed in the sector for 4 years. But the truth is, in that bull market, the 5 uranium juniors that had survived the 20-year bear market that led up to that bull market were such extraordinary performers in that brief bull market. The worst of the 5, the poorest performing of the 5, generated 22-to-1 returns. And what you find, pardon the pun, is that the sort of explosive upside in the better uranium juniors is so much that they can amortize almost any time value of money discount that you want to put in place.
Do you think that's realistic this time round, given lessons learned?
For 2 reasons. There is still a club of investors, if you will, old, fat, rich guys that went through the last bull market. And if you give them half an excuse, I think you'll see a stampede into the few uranium juniors that are left. And the uranium juniors that are left are, pretty tough survivors. They've managed to hang on since 2007, 2008. They've managed to hang on for 12 or 14 years of pretty hard markets. It's strange that there were 5 uranium juniors at the beginning of the last bull cycle. There were 500 uranium juniors at the top of the last bull cycle. And there are probably 12 viable uranium juniors, and I may be overstating the number today.
Yeah.
So the same circumstance happens when the investment community gets tempted back into the uranium space. There is a very small opportunity set available relative to the cash that remembers the last cycle and wants to come into it.
But therein lies the problem. There were a lot of people left holding the baby last time around.
Yes.
Some people made a lot of money, and a lot of people lost money. And that enthusiasm, and so it comes back to the question of, are people equipped to make these sorts of decisions? Which horse do you bet on? What, you've given some clues as to what people should be looking at in terms of doing their homework and so forth. But uranium's quite an interesting space. If it does replicate the last cycle, it replicates the last cycle.
I think that's accurate. And I think what you say is true across the broad spectrum of resources. Markets always overcorrect. What happens, let me rephrase that. What happens is that people who are interested in the uranium narrative will, because of their concern about time value of money, and because of investors' want of immediate gratification, people won't buy the uranium stocks in anticipation of a price move. The price move itself will be the stimulus that causes people to come into it. This is very strange to me, and I'm guilty of this too, just probably to a lesser degree than some others. We believe that we're sort of, sentient, rational human beings gathering information from the whole cosmos, processing this information, making rational conclusions. And that's not true. What we really are people who are looking for information that supports and makes us comfortable with our existing paradigms.
Confirmation bias, we call it.
Correct. And the most important information to us is the most recent. Expectations of the future are set by experiences in the immediate past. What that means, oddly, is that let's say that there is a stock that's selling for $10, okay? And let's say that it comes to the attention of some people and it's selling for $20, but there's been no change in the underlying fundamentals of the company. The investor who owns it at 10 loves it at 20, and the price information justifies his or her narrative. Now, the fact that it's gone from 10 to 20 makes it arithmetically precisely half as attractive as before the move. But oddly, it becomes a Geffen good. It becomes one that is valued more highly as a consequence of the price than of the value. When the first time through in the uranium stocks, came into them, the price of uranium was between 8 and 10 US dollars a pound. And I remember thinking, the price could go to 40. I was wrong, it went to 150 or something. Now, at about 60 US dollars, it was very clear to me that the price of uranium didn't have to continue to go up. And I began to loosen up. The truth was much, much, much too early in retrospect. But I'd rather make that kind of mistake than overstay my welcome. When you look at any commodity subset, what you see is, in Canadian parlance, a series over 30 or 40 years of hockey stick graphs. The front side of that chart is a lot of fun, but the back side is just as steep and much less fun. And so you have to have a mechanism, a discipline that will cause you to sell. If your mechanism is a value-focused mechanism, like mine, what happens is that you will inevitably buy too early, and you will inevitably sell too early. You will make often a stunning amount of money in the middle, but you will punish yourself, or at least be punished psychologically, for 2.5 or 3 years on the way in. And you'll punish yourself again for the last 12 to 18 months of the bull market, taking, however, perhaps a fat slug out of the middle.